Welcome to tonight's meeting of the New York Technology Council. Delighted to have you all here. Tonight should be a great session. I'm going to let David introduce the session and the speakers in more detail, but I wanted, for those of you who are new, to tell you a little bit about us, New York Technology Council. We're a nonprofit. Our mission is to help the New York technology scene, companies and people in it. We're a membership organization. You can join as an individual, you can join as a company, and we also depend heavily on our sponsors. It's not an exaggeration to say we wouldn't be here without them. I want to thank New York Law School again for making this facility available to us. And with that, let me turn it over to David Anderson, who will take us from here.
Thanks, Eric. I'm David Anderson, the moderator tonight for this session on a very interesting case that has just come down from the Delaware Chancery Court in the matter of Trados. So we've called the session "Don't Give Away the Store: A Cautionary Tale" in the matter of Trados. The question may well arise in your minds then, who's the cautionary tale for? Who's to be cautioned? And the first answer is that it's those associated with development stage companies that are issuing preferred shares in financing rounds. And indeed, that will be a major theme of the presentation. The case is all about the relative rights and values of preferred shares and common shares in a company that developed well and sold at a good price, but nevertheless ended up in litigation. So to sort out a topic like this, we've got the assistance of Bonnie Rowe, Mergers and Acquisitions attorney. Yeah, we want to make sure you recognized her.
Significantly more hair.
A partner at Cohen and Gresser. Our more developed CVs are on the New York Tech Council website, so I'm not going to spend any more time introducing us than that. And an audit partner, Lou Pizzoleo, at Grassi and Co. I'm the moderator, but I'm also the valuation person on the panel, and so there's going to be a point where I'm on the panel and Bonnie's the moderator in about 15 minutes or so. We're going to go until 8 with what we've prepared. We'll have some time for question and answers. After that, though, you're very welcome to interrupt during the conversation as well. Please don't be shy. I said that the focus was on the cautionary tale for those associated with development stage companies that would be issuing preferred shares in financing rounds. But there's a secondary topic and focus for the presentation as well, and that would be the legal professionals in the audience, because the same valuation and legal issues that are to be understood in order to understand the cautionary tale from the point of view of the issuer of preferreds in financing rounds are also necessary to understand the very fabric of the case. And this is from the first of the decision. These two quotations are from the beginning of the decision, and I'm going to leave them up there while I ask the panel to to introduce us to the facts and circumstances that led to this litigation. As I say, the decision just came down and was published in August of this year. It's such an interesting case. I wouldn't be at all surprised if it wasn't a type case for discussions in valuation and in M&A and in financing for this kind of problem. Let me start with Bonnie. Just in oversight here, what happened that led to court?
Okay, well, sorry if this sounds a little bit.
Yeah, can you hear us? Good.
Okay. What you can sort of hear in the Trados case is sort of a distant echo of the internet bubble bursting. But it sort of tells you, like, listening to the distant echoes of the Big Bang that are sometimes reported to have been heard or recorded somewhere. It sort of tells you a lot about VC financing in general and sort of the history of companies like this. So Trados was a small company that had started in the late 80s, early 90s that made translation software. They translated my English into your French or your Japanese. There were a couple of products like this on the market. And the company was owned by its common stockholders. And in 2000, they decided that, really the IPO was not far away and that they would embark on a rapid expansion. And they got a bunch of venture capital investment in the form of convertible preferred stock that is, at least in my view and reading the case, appears to be fairly typical convertible preferred stock with an 8% accumulating dividend and a liquidation value equal to its purchase price. So over the next couple of years, it went through a couple of rounds of financing, which we'll describe in a minute. And the company did well, but not exceptionally well. And at one point, they had a little bit of trouble. But they turned the business around. And then the VCs, who were, in effect, at that time in control of the company, decided to sell the company for $60 million. And the end result of that was that the proceeds of the sale went first to management pursuant to a management incentive plan that they decided was necessary in order to do the deal. And secondly, to the preferred stockholders to pay out their liquidation preference. The preferred stockholders all got their purchase price plus a reasonable amount of the 8% return, although they didn't all get exactly their 8% return. And then the common stockholders got zero. One of the common stockholders decided to sue, and basically the Delaware Chancery Court determined that although the board had run a totally unfair process, a process that, and I'm sort of, in saying this, I'm adopting the view of the court. The court thought that the process of selling the company was unfair in many different ways, but based on valuation, they decided that nothing at all was entirely fair.
For the common shareholders. So, well, thank you.
Okay.
So let me get this straight. So there's some guys that start in Germany, I think it was actually, to start a software company, and they're early on the bandwagon, and they get it on desktops all over the place, and they get a deal with Microsoft, and they move to the enterprise market, and they build their company, and they sell it for $60 million,
Right.
and they got nothing.
Zero.
Right? They had common shares,
Right.
and they did what you're supposed to do, and they sold the preferred shares in order to grow. And then when they sold out for $60 million, the common shares got zipped.
And to add
Is that it?
insult to injury, they were forced out of the company.
And the VCs forced them out. Okay.
Jobless and zero for the company they founded.
So there's the general outline of our cautionary tale.
Right.
That something happened in this case where the founders gave away the store.
Yeah. Now, presumably they did use the capital for the business of the company, and there was nothing that was. I mean, the VC board followed the terms of the agreement, so it's
Right.
there is an element of justice in this.
Well, we'll have an opportunity. Everybody will have an opportunity to see if we agree with the court after we go through it. Lou, you're the numbers guy. You're the accountant. Tell us just quickly what the issuances were.
Sure.
That got us up, that got these guys into such a hole that their hard work and their bright idea got them zipped.
If you think about what was happening in 2000 and 2001 when they went to the venture market, especially in tech, you might sort of reflect on the whole thing and say they were a little late to the party. This company was founded in '84, was an enterprise software model. In the mid-'90s, companies like this were IPOing without revenue for some ridiculous valuation. So to start a process to raise venture capital in 2000 and do an IPO, they may have been a little late to the party. But over 4 years or so, between 2000 and 2003, they went to the venture market and they raised about $27 million in cash. The instruments that they used had, and Bonnie will get into this later with David, had liquidation preferences. They also had veto rights and things that allowed the venture partners to really take over control of the company. So in addition to the liquidation preferences impacting the valuation of the common, they also lost control of the company because of the way they were structured.
Now, did this happen all at once, or was it a gradual thing?
It was a gradual thing. They did a
sequence?
$5 million raise in 2000. They did a $10 million raise shortly thereafter. And then there was some follow-ons with additional investors, $3 million, $2 million, $3 million, $2 million. They also used the stock as a currency to effect some acquisitions, which is very common. So, in addition to raising $27 million, they also bought a company for about $11 million in stock.
And that was another round of preferred.
Another round of
There's like
preferred.
A through F preferreds by the time they got through, right?
Yeah, and it's interesting when you look at the preferred that they were issuing, and this is one of those reflection things that I was doing as I was reading through it. The preferred that they issued compared to what you see today in a typical venture round looked very different. I think, maybe some have listened to the cautionary tale and the preferred that I see today. Some has liquidation preferences, but it's very uncommon to see these veto rights and things of that nature where the entrepreneurs basically lose control of the company. Board seats typical, but the veto rights just seem pretty punitive compared to what I'm used to seeing today.
Okay, so between 2000 and 2003, we've got a whole bunch of series of preferreds that get issued. They've all got all the bells and whistles that we're going to look at in just a minute.
Company was growing steadily.
The company was growing, had a little down, had a little flat
10
period,
to
but it was
20
otherwise
million
growing,
revenue,
and they're
got
on
a
their
$4
way
million
to
valuation at
payday.
one point,
Yeah.
looked good.
Maybe they issue a few too many because they use it to do the. Did anything happen then between 2003 2005 is when the sale took place that occasioned the litigation later. Between 2003 and 2005, what's the MIP, Bonnie?
Well, let's see, I think it was about 2004, the company had made this acquisition. It had not done well, with the integration process between the acquired company and the Trados, the company that acquired it, and the company had experienced some difficulties, and there was also some management changes, and there was a cash flow problem at one point, and they brought in a super competent executive, guy named Campbell, who turned the company around. And for him and for other employees to incentivize them to work towards an acquisition, they created what they would call the management incentive plan. And this was sort of, in a way, it's sort of an anti-common stock, because it sort of allied the management to the idea that they were going to get a cash bonus in an acquisition that would not necessarily yield any return to the common stock. So even if they had common stock or stock options as management, they were allied to the preferred stockholders who controlled the board.
Okay, well, wait just a minute here. Let's make sure we understand exactly what the MIP is, and in legal terms as well, especially for the corporate group in the audience. Now, we've said, Lou was saying that they issued A through F series of preferred shares, and we're going to talk about that. Is a management incentive plan a preferred share?
No, it's not equity at all. It's just a cash obligation. So in effect, it's debt or it's an expense that gets paid.
Where does it reside? Where's the piece of paper that says what it is?
There's a 5 or 6 page plan. Presumably they had award agreements, but the plan actually says, the CEO gets this % of a pool and the COO gets that %.
So it's a contract.
Yeah, it's a contract.
It's a contract.
Right.
Is it in the Articles of Incorporation, which is where you set out what the terms of your equity are?
No.
Okay.
It's
a
just
separate contract.
It's just something approved by the board.
But this particular contract says what? It says that if there's a sale, the participants in the plan get how much?
I think it's 13%. It is an amount that varies depending on the sales price, but it was 13% at $60 million.
So it was pretty rich.
It was like turned out to be $7.8 million. Yeah, management gets that. So we've got that, and we've got all the preferreds lined up senior to common.
Right, exactly.
Is the situation.
If the common holders had a say in structuring that arrangement, there may have been a floor on valuation where the management didn't participate until that floor was passed.
Right.
But this was right off the top.
To be sure, the valuation question, the importance of the valuation question is evident at this point, because each one of those preferred issuances and the MIP required some valuation analysis to keep management out of the hole that they ended up getting.
Management had no incentive.
Something must have gone wrong.
Their interests weren't aligned with the common.
Right, and there are two things that I don't want to get ahead of you, but there are two interesting elements of this. One is that the management incentive plan said that if I received proceeds from the common stock, that reduced what I'd get from the incentive plan. So in effect, I became focused on getting what I could get out of the management incentive plan, because what I got out of the common stock was neutral. So that's one element of sort of an unfair conflict.
Yeah, and that's just in the contract.
Yeah,
okay.
that's just
Hold on
in
to
the
that, because we're coming back to the incentives that these kinds of equity and the MIP imply for the board and decision making in just a minute. To set this up then, okay, let me point to the language of the complaint in the case. So this is what the common shareholders complained about after the sale that netted them zero. The plaintiff, the common shareholders, contended that the board had a fiduciary duty to continue operating Trados, to keep going, not to sell. That's the complaint. That's the complaint. And behind the framing of that complaint is a valuation notion that comes out of the relative value of common and preferred within a capital structure like this. So there's my piece to the second subgroup in the audience, namely the attorneys. Yeah. To understand this, you've got to. Yeah, question.
Question, if I'm not interrupting.
Sure. Go ahead.
Complaint that they should have done a better management incentive program.
Well, I don't know, but let's
I think I can answer that if you.
When the time comes, Bonnie will have thought up the right answer for that.
I think the complaint did allege that people were unfairly incentivized. So that was in effect part of their concern. What the valuation piece is that there were sort of three, and maybe I should have mentioned this in setting this up, there were sort of three possible ways that this company could go when they established the management incentive plan. They decided that they could either do a quick sale of the company for not very much money. They could kind of clean up the company and do a reasonable sale at a price that would get all of the investors out at least their purchase price plus a good return, or they could continue the life of the company and try to embark on a new strategy to recoup value for the common stock. And in effect, what their decision point was not to go on that risky last strategy that at least arguably might have return value for the common stock. And the court had some views about whether that was a realistic strategy, but that was really the gist of the complaint was you should have pursued that other strategy that had a chance of recouping value.
Part of your question relates to what the fiduciary duties of the board are, right? Could you complain about that as being a breach of the fiduciary duties is to maximize the value of the corporation as a whole, generally speaking. It's not at all clear in this litigation that decision in and of itself would have been outside the fiduciary. It might have been a mistake, but it wasn't necessarily a breach of fiduciary responsibility. Mike?
David, and to the panel also, and which I think is very pertinent to some of what people who are in the early stage entrepreneurs in the audience, and it's a lesson. Were the shareholders, were the common shareholders early on pushed to the wall because of operational problems within the company to make a bad deal? So that you're saying they got $60 million on the sale, right? And the people with the management incentives got 7 or 8, right? So that leaves over $50 million of a pie for everybody else, and here you have all the A through F preferred shareholders now with 30% return. They had to know at a certain point that if they're selling equity in the company, right, unless they were able to get a certain amount of dollars, and plus they lost control too, because they had no control here. So lots of times, I guess, when you're taking on this professional equity, you have to understand, what the ramifications are in the terms of the contract that you're entering into.
This cumulative
And
dividend.
are you gonna get to that, or am I?
I think that may be one of the things we conclude at the end, that from the point of view of the founding shareholders, you got to track the liquidation preferences and dividends and what they add up to, as well as the control of the board that they imply.
As well as the realistic expectation of the founders in terms of achievability.
Of achievability value of the company. Exactly.
It had
Okay.
a pretty
And this can all be
significant
brought.
Cumulative dividend here that added to the liquidation preference, so that was.
Okay, now, and let's see how this recasts the valuation issue, Mike, because what the court decides then is that the valuation issue is not what the company was worth at the time that it sold, because the question is, should they have not sold because they could have grown further? The valuation, and it's not actually in the valuation report, it's the smart chancellor, the smart judge, that saw the economic basis of the case. What he looked for in the valuation report was an answer to the question: what was the chance that the company could grow fast enough to get ahead of those hurdles? That was the valuation question, and he concludes no, there wasn't a reasonable chance that they were going to grow fast enough to do that. It's not that they wouldn't be worth more in the future; it's they wouldn't be worth enough more. But again, the specific, so that's kind of an unusual, valuation decision. Let's back up for just a minute and look at some mechanics, because I think that the mechanics of the equity and the valuation of preferred versus common is important to see in order to understand how this unfolded. So. Valuation issues for financing rounds. Since venture capital and private equity financing is so often through preferred issuances, the resulting complexity of the equity structure, of the capital structure, creates very significant valuation problems. And it's a valuation problem. The valuation problem on exit, on liquidation, is not all that hard, because you just have the rights of the preferred that need to be satisfied. You see what it leaves. But there are very significant valuation problems before exit, which is also in effect what the judge was looking at, because the case was, well, what if they had gone on and not sold? And it can be boiled down to this problem. You know that what the company is worth, but how do you allocate it to all these different classes of equity? They're all different. How can you do that? You got A preferreds, B preferreds, C preferreds, and the complexity of the preferreds and the bells and the whistles that are built into the preferreds, which are essentially contracts on top of a basic equity concept, right? It's common stock plus a contract that says that this equity holder gets extra things. The complexity thereof is only limited by the imaginations of the venture capitalists. And they've got a lot of imagination. They can think of a lot of bells and whistles they'd like to have if you want their money. So that leads us to the question. First of all, what were the features of the preferred in the Trados instance? And I want to frame that up again with an eye toward those directly involved in financing and in development stage companies. A more general discussion of what the common features of preferred can be, and the kinds of difficulties that they can sometimes lead to. And then finally, the kinds of incentives that they imply for the different elements of the board of directors. And we're going to lean on Lou here. He's the guy that audits the financial statements that describes the equity section of company after company. So he sees a lot of these things.
Yeah, there's lots of tripwires. I was just talking to somebody in the audience. As an entrepreneur, when you're sort of headed out to do this, especially the first time, if you haven't been there and done that and you're not a serial entrepreneur, it's good to have your accountant that's next to you that's seen a few, your attorney obviously next to you that's seen a few. The other thing that may not be obvious is if you have a friend who's in venture capital, and all entrepreneurs do, because when you start out, they're on you like flies to the brown stuff. So find one that's not participating in the deal will help you evaluate the deal that you're doing. Because, as David said, lots of imagination. Every day you see something different, and there are lots of tripwires. And not just tripwires in valuation. tripwires and things that could just cause drama and cost to your sort of annual compliance. One of the things we were talking about earlier is a common feature of a down ratchet.
Well, let's look at it when we get there on the list. You can't see it, but there's a list behind you. We're going to run you down the list.
Sure.
Before we run you down the list, just quickly, Bonnie, where is the piece of paper that says these things exist?
Well, it's in the certificate of incorporation. It was probably done as initially a certificate of incorporation that just said there was common stock and some undesignated series of preferreds, and then there are different series of preferreds that are sort of described in documents that continue to amend the certificate of incorporation.
And there's a copy of that in the offering piece that went to the investor, probably, for each of those single preferreds.
Exactly.
So it's different from the MIP in the sense that it's in a different document. The effect. Okay.
Right.
All right. So Lou, quick now. What's a dividend with regard to preferred equity?
So
what are some of those?
Acts similar in a preferred instrument to an interest rate. In the Trados case, you have an 8% cumulative dividend.
On what? Interest 8% on what?
On the face value of the
investment.
preferred. So they put in $5 million, they got 8% of that $5 million annually. It was cumulative, whether it was declared or not, and it added to the liquidation preference. So this is what we were talking about earlier. You had this sort of burden, and I've sat with a lot of entrepreneurs when they're considering this type of thing. I don't think any of them have ever considered it the way that we were just talking about it. If you have an 8% cumulative dividend, you have to outpace that 8% growth in valuation to have any return for yourself. That's a pretty significant burden when you can't tell the future.
Okay, well, we're going to add it to another burden right away. What's a liquidation preference?
Liquidation preference puts the instrument in front of the instruments before it or after it. So in this case, the Series A had a liquidation preference that put it in front of the common. And then there was B through double F, I think, that went behind the A.
What determines the liquidation preference usually? Is it the investment amount?
It's typically fixed. In the Trados case, it was the face value of the preferred plus this cumulative dividend. But sometimes it's fixed at a certain valuation. Sometimes it's discounted on a future valuation.
Yeah, it can really varies. It can be set at various things. In this case, so Trados had dividends. The Trados preferreds, all A through F of them, had dividends and liquidation preference. And the dividends were 8% cumulative on the investment amount. So
sometimes you'll see a dividend in a preferred stock that has to be declared, so the common shareholders can determine whether or not it's declared.
That wasn't the case here.
That wasn't the
case. It was just going to accumulate no matter what.
Whether we can do it or not,
forever.
it's accumulating.
And then there's the liquidation preference. The liquidation preference, if I understand you correctly, means that the preferred shareholder gets the investment amount. In the case of Trados, it was the investment amount. In any case, some stipulated liquidation preference back for if you sell or if in other circumstances, you get that back first.
Yes.
That sounds like debt. You're an accountant. Why isn't that a liability?
In this case, I don't believe it was, but in some cases it is. It depends on the instrument.
It's debt-like in any case. It may be in the equity section, but it's a first claim. It's a senior claim on the proceeds. So in the Trados case, there was a liquidation preference for each of these preferreds, and there were accumulating dividends in each of these preferreds, and those things all added up.
Yeah. This next one, redemption rights.
Now, what's a redemption right?
That's when they can basically put the preferred stock back to you and demand cash.
So who can put it back?
The holder of the preferred stock.
So the investor can now tell you, okay, I need my liquidation preference back now, not just when you sell.
Yes.
Okay.
So sometimes that's mandatorily redeemable at a certain date. At this date.
Like when the VC wants to get out.
Yeah. Sometimes it's mandatory. Sometimes it's not. Sometimes it's upon a certain event. In cases where it's mandatory, that puts the instrument into liability account.
Bonnie, were there redemption rights in the preferred in the Trados case?
No, there weren't, but interestingly, since the preferred was in control, you didn't need a redemption right because they could, in fact, dictate when a sale occurred, so that, in effect, they didn't need a right in the charter to do that.
is it fair to say that if there had been redemption rights in all of those preferreds, that there wouldn't have been a case? Because there wouldn't have been any question that the preferred, by contract, had the right to say, you gotta pay me back.
Well, they could put
No,
it back, but
yeah.
the company likely wouldn't have been able to pay it back anyway.
No, I actually don't think so, because I think that the key to this case is partly, it's not really the structure of the preferred, it's that the preferred actually got control. And so, in effect, they were acting, I mean, when I have debt, I usually am dealing with my lender as a third party. And here it was sort of worse than debt in certain respects, because my lender was me and was dictating what I do.
Right, okay, so we're coming down to the last bullet point, which on the screen, which is that the preferred series often have guaranteed seats on the board. One or more stipulated for the class as a whole. The Series A preferred gets one board member, and the Series C preferred gets two, something like that. Is that right? And is that what happened, that there's so many members of the board?
I think that's part of it. And then the other thing is that the preferred got to vote on apparently on an as converted basis. The preferred gets to convert into common, and obviously they would do so if they really were going to have a home run with this company. But in the meantime, they got to vote with the common. So they basically just had a majority control on ordinary business.
And they also had a super veto, they could veto any change of control issues that the board decided. So
There was special
each one
veto.
had a veto,
Which is not on the list, but should have been. I should have put it there. Okay, you mentioned conversion rights. What are conversion rights on a preferred?
Essentially a right to convert, to exchange my share of preferred for a different class of stock, usually common. Basically when you might want to do that was if the company was going to really sell for a huge multiple, you'd get more than you'd get on your basis of your preferred stock.
Now, if you choose to convert to common, then you've got common. You don't have preferred anymore. You don't have your liquidation preference, right?
Right, exactly.
So when would you convert?
A minute before the closing of the acquisition.
Right. Well, or only when the value of the common as converted is worth more than your liquidation preference.
For example, if there was an IPO, the common stock becomes publicly traded, and I want to sell my stock in the
That's
market.
traditionally when you
All right.
see-
Yeah.
Because we got to look at Michael.
Can you just comment on the participation rights?
Yeah, that's right.
It's liquidation and.
Absolutely, that's next.
Exactly.
Then there are also in the imaginations of private equity and venture capitalist investors something called participating preferreds. What's a participating preferred, Lou?
Trados had this, which their first round, in addition to
Only the first round, only the
first
preferred
round.
A's.
In addition to
Trados.
their 8% dividend, they participated in the common shareholders' growth and dividends and anything of that nature. Had super votes.
Okay, let me ask you then, what's the pay, how does the payoff calculation for a participating preferred work? So, first of all, you get your liquidation preference.
You get your liquidation preference, including your dividend.
And your dividends. But then if you're participating preferred, you still get to convert. It's not either or with the conversion. You also get to participate as if you were converted with anything that's left over for the common. So the payoff schedule is a little bit different.
Like a triple dip.
With the other classes of preferred that were not participating, what's the payoff schedule? It's either or, correct? Either you take your liquidation preference plus your dividends, maybe you get the dividends anyway, I don't know, or you convert to common and you get whatever common's going to be worth. Is that right?
Yeah.
Okay. All right.
Like I said,
Yes. Sure.
I understand most of this. This is basic about valuation. Are you telling me that when a company does annual valuation, that the person doing it is not responsible for looking at the composition of the equity to understand how they impact each other.
They
I have
absolutely
a good
are.
friend who had a bank,
Yeah.
and he had investors. And he always looked, when somebody came to buy the bank, not at what they were offering, but what the implication would be for the different levels of investors. It just seems so common sense.
Of course,
Better
of course,
question
but
for
it's
David,
hard.
But, yeah.
You know, it's hard,
When you start-
it's hard to see how the total value gets allocated when you've got such complexity.
But what I'm trying to figure out as an entrepreneur, is this something I had to ask somebody to do?
Yeah.
Specifically.
You know,
Yeah, you're right.
Yeah.
Is that your fiduciary responsibility to break that down?
If I'm a member of the board,
If you're the guy doing the valuation?
Yeah. They're gonna tell you what the
Yeah.
evaluation is. I mean, if you get a good one, like David, he may sit with you and go through what each class is worth and how that impacts each class. But I've seen lots of valuations get done where, here's what the common's worth, here's our report. You know, and valuation, and you could speak more to this than I can, in our marketplace, goes from a boutique sole proprietor that does it out of his barn in Connecticut to a firm like Eisenramper and the Big Four that do valuation as well. And the quality and the guidance that you get varies depending on who you engage, as does the fee,
But
like
it does
anything
fit
else.
under the domain valuation. What I'm trying to figure out,
Yeah.
if I say evaluation, is that analysis included? Or it is, give me a valuation, but let me tell you what else I need?
It would behoove you to press your valuation specialist that you hired to sit with you and go through the cap table.
Right.
that's right. And you may be in a situation in your first discussions with your funders where they just talk about value in terms of as converted. That simplify it,
Right.
okay? With this preferred's just worth what it's worth as if it were converted to common without considering the additional value of all the bells and whistles. And your valuation consultant might well help you understand that. And the specific dynamics. We'll see if we can do a little bit more on the mechanics of valuation in this sort of circumstance.
I
Yes?
just wanted to make a comment. I don't
Sure.
know if there are any venture capitalists in the room. I'm not, but I think all this points out the key to finding the right
Yes.
Yeah.
venture capitalist.
Yes,
Because
absolutely.
If you get a venture capitalist who's interested in being a partner and growing your company, they're not going to ask for participation
Yes.
rights. They're not going to ask for multiples on your preference. So, you know, a lot of this is important stuff, but finding the right partner is critical. Having this
I would trust them, but verify also.
I mean, the word partner
I don't know
in a
very many
sense,
VC firms that turn down the bells and
No,
whistles.
I do. I think you go talk to a bunch of them.
Yeah, the ones that take the long view want the entrepreneur to succeed and grow and be a venture partner long term in their first entrepreneurial venture, in their second, in their third, and their fourth.
Yeah.
So venture partners do vary, you know, firm to firm as
Choosing the
well.
right one is
Yeah.
key.
Yeah.
That's a very good point. And that's why it helps to have your trusted advisors around you when you're going through this. It's not an advertisement, but you know, your accountant, your attorney, your friend who's a venture banker who's not participating in the round. You know, some entrepreneurs even have, you know, an investment banker advising them depending on the size of the round. So, you know, it's if you haven't been through it, it's helpful to have your trusted advisors around you to ward off these types of tripwires.
Really, in this case, though, if you look at this, other than maybe a few things around the edges, this is not an unusual structure for
No.
financing. So,
No.
so really, the causation of why the common guys didn't get any money is because the company just wasn't worth enough at the time they sold it. So,
It's a little bit of timing, but I mean the veto rights are, not that I've never seen them, but it's pretty atypical. I mean,
I'd agree, but I would also be a little bit more precise about what you mean by the company wasn't worth enough.
well, meaning that when you go through all the liquidation preferences, if you have the $60 million or $50 million, whatever it was, and you do an analysis and say, okay, to satisfy the cumulative dividend and the liquidation preference associated with all the preferred stock, okay, that's got to be whatever, 48 million, and there'll be nothing left over, a little bit left over for the common. So, I mean, one thing is the value as a whole. I mean, the company just has a value. The buyer doesn't necessarily care, other than, you know, incentivizing management. to stay
value's
on.
either there or
They
it's
don't
not.
really care where that money goes, right? So
Yeah.
we're gonna pay you 60 million, and it's up to you as a company how you create your capital.
That's
structure
right.
To figure out how it's all divided.
yeah, I mean the
That's-
thing we talked a little bit about before. This guy Campbell came in and did a little bit of a turnaround before they sold the company. So you know, would it have been different if he did a longer turnaround? would you have generated more capitalization?
Let me, just following up on that, because that's a great comment. So it's apparent to everybody at this point that you're right, that you need to track, you the company, you the stakeholders in the company, you need to track where that hurdle is over which you have to get for there to be value to all of the lower part of the equity section. That's
hurdle, David, gets higher and higher each time you do an A, a B, a C, a D, and an F.
and because of the 8%, in this case, we had 8% dividends that were accumulating. So it was 8% on top of the
Compounding.
I mean, I'm not a VC, but let's not forget, you're getting the money every time you get that.
Yeah.
You're getting
Yeah.
$10 million.
Yeah.
Hopefully your company's worth $10 million more, or you're taking that, making your company worth $20 million more. So it's not as if they're just giving it to you and.
Absolutely.
Okay, we're getting more for nothing. They're
No, it's
giving-
growth capital.
absolutely.
They
It's
should have
not-
been able to
Yeah.
grow it past the 8% hurdle.
The VC is not the bad guy. And the company's not the bad guy. But the question of how you understand it and how you track, how you quantify it, is then the real value.
You know, the other thing that we talked about when we were preparing for this is, was the valuation at the preferred round right? Was it too high or too low? Because this liquidation preference was set at the value of the preferred at that time. So it could have been a valuation issue at that point. They may have overvalued the company when they raised the preferred. And
Right.
yes, they got the cash, but they weren't able to hit the growth hurdles to generate more value over and above that. So.
In this case, then too, we did have at the end of the line of the preferred issuances the MIP, and it ended up being 7.8 million, which was a significant addition. And we've covered that, so I'm going to skip that. I'm going to skip that slide.
One more question.
Yeah, sure, Mike.
So, and maybe I'm getting ahead of it, maybe it's coming up in your presentation. So obviously the preferred shareholders who now control the company had to make a judgment and say, listen, if they could have gotten $120 million for the company 2 years later, right, why wouldn't they have waited, right? They could have then converted to common, right, and participated and gotten a hell of a lot more return. They must have thought, this is, at this point, we're not going to get anything more, so hell, we're just going to.
Right.
For every
On
dollar,
a risk-adjusted basis. That's a brilliant question, because that actually is the very next topic.
Okay,
Because it has to do with the payoff schedule for the different classes and the incentives that those give to the holders of that class, right?
It's also like raising a poker game. For every dollar that they got over that liquidation preference, it was diluted by the other common holders. So they really had some incentive, but it wasn't enough.
Let's think about the incentives for somebody who holds the liquidation preference and the dividend and a conversion preference, as opposed to the common shareholders. What's the payoff on that liquidation preference if you've got a company like this one that's growing modestly, not growing spectacularly, right? It's growing at 8%, let's say, on average.
It's not
over time.
Snapchat.
Right?
It's not Snapchat.
Yeah, that's right. If it goes through the roof, everybody converts, and of course we know what happens there, But we got a company that's growing modestly. The payoff for the liquidation preference. Let's go back to it. The payoff for the liquidation preference plus the dividends, which the preferred shareholders hold, is big. They get a lot back. They get their investment back, and they get 8% back. And what's a venture capital business model? It's not to stay invested for 20 years. They want their cash back so they can invest in something else. So they've got an incentive. Do they have a strong incentive? Let me phrase it this way, Mike. Does the preferred shareholder have an incentive to hit for the home run if it involves taking a lot of risk with the company? No. Right? Because if they don't take the big risk, they still getting plenty, just doing okay. And so we get out and we put our money someplace. We did okay. What's the risk? What's the payoff profile for the common shareholders, for the entrepreneur that founded the company? With this kind of structure, they're not making any money at 60 million. What's your interest in that situation? The question is, should we invest in some speculative new thing that might land us a grand slam, but also might sink us? What are you going to do as the common shareholder? you're going to go for the grand slam.
Money's already spent.
Right.
Right? So the decisions about the business are incented very differently depending on which class. And what Bonnie's been saying is that the way this story developed is the people that had the interest in the more risk-averse, conservative, let's just get the hell out and take our 8%, had control. So that was the decision that was made.
Yeah, let's deploy the capital somewhere where I can get that 10 times.
Is that fair, Bonnie?
That's exactly right.
Yeah,
So
yeah.
at that point, the entrepreneur can make a difference, because they had no control in the company anyway.
That's
Right.
sort of the root
That's
cause.
sort of what happened.
Right,
Yeah.
you see it? You see it?
No, I
Yeah.
got it. You said, that's why I looked shocked, you said the common shareholder.
Yeah.
That was the
The,
guy.
the entrepreneur is the common
Right.
shareholder in my simplification. That's right.
Yeah.
Okay. So that was a great question, Mike. All right. Now let me go back to the valuation mechanics just briefly. It's 7:30. We got a little time to row slow, as they
Just
say.
one
in the-
comment on the MIP.
Yeah,
We
yeah,
were
sure.
Talking about that. You know, if the MIP was a stock option plan where they got common, instead of the first 13% valuation, those management would have been more incentivized like the common holders.
Absolutely.
Yeah.
Absolutely.
So, you know, I think this case, the way that it presented, there's a lot of things that were, you know, evident that the preferred holders sort of took over the board and made their incentives aligned with management rather than the common holders.
Absolutely. In this case, the MIP, as well as the preferreds with liquidation preferences and dividends, were incented to take the less risky course.
Exactly.
Take the 60 million.
Get the money and run.
Take the 60 million. We get the first 7.8 million of it. We're fine. Campbell got 2.5 million himself out of that MIP. The guy who, you know, and I think was he on the board?
He was.
Yes.
MIP, that was his management, so they were, you know, some of them were on the board
He was in
too.
the company for about a year and a half.
Yeah.
Maybe.
Yeah. So maybe in retrospect, that's a mistake in terms of the company. So, okay. If we're all right then with the setup, let's look at the mechanics then of how you might try to look at value, not just at the exit event, but back when you're making the decisions about how much to issue and what the terms of the issuance should be, say 3-4 years before the exit event. Okay, so this is what happened more or less in the Trados case with the numbers from the Trados case. It was 60 million, and then there were some adjustments in the transaction negotiations, and it ended up being 57. The management incentive plan got 7.8 million off the top under the terms of that contract, even before the liquidation preferences of the preferred. That left 52 million for the preferred, but the combination of preferred liquidation preference and dividends was 57.9 million. So that left zero for anybody else farther down the waterfall. And the technical term is a rather cute one here. That's the liquidation waterfall. You know, you see how far the water dribbles down. It didn't get down to the common shareholders. Okay, now let's look at that valuation question from the point of view of the situation 3 or 4 years prior, let's say 2002, 2003. Let's say that our estimate, we don't have an offer yet. We just think our company is worth 57 million because we got David Anderson to run some valuation benchmarks, and he says maybe that's the range, okay? So we think maybe we're worth 57 and we're going to grow, and we've already raised capital, so we got 57 million of liquidation preferences sitting in our equity section right now. Would you conclude, for a going concern, 3 years before possible exit, that the value of the common stock and all the options is zero? So we're zero?
Is that what their 409A valuation said?
No, that wasn't.
It wouldn't say that. The 409A wouldn't say
Say
that.
that, right.
And why? Let me put it this way. Let me ask you the question. Here's a going concern. It's got growth opportunities, no doubt about it. Management's okay. They've got some capital. Their current value is about 57 million. If you think you could sell the company about that today, they don't want to sell, but that's about what it would be worth. And there's 57 million in liquidation preference, and I'm going to give you common stock. Do you want it?
Sure.
Why?
There's always upside potential.
Because there's upside potential. So you participate in the upside with the common stock.
Over 8% in this case.
You participate, how do you participate in the upside?
You said you're going to give it to me, so of course I want to.
I'll take it.
I'm going to give it to you.
But if you said, should I do $25,000 worth of work for it? Well, then it's the question of what is the chance of the upside? I've got somebody telling me it's only worth 57, which really does mean it's worth 0 what you're giving me.
Right, if we liquidate today, But as you say, there are growth opportunities, so.
Well, it's a real valuation. It's not just speaking about liquidating today, it's speaking about the future.
It's about that future. Okay, so we've got a situation in which you're saying, I got these common shares, and they aren't worth anything now, but if the enterprise value of the company goes up over 57 million, they'll be worth something. So you've got an option to participate over a hurdle. Sounds to me like you got an option, not common stock. Or rather, we can define financially, in terms of financial math, we can define what you have as an option. It's an option on the enterprise value, not on a stock price like the traded options on the exchange, but it's an option on the enterprise value. If that enterprise value goes up, your option's going to have value. If it doesn't go up, you don't, but it's not going to go below 0.
Well, the other major thing is that for the common shareholder, even if it was worth 0, if that wasn't known, somebody had to pay taxes if it were given to them.
If it was
If
worth
you were
more
to give
than,
somebody
Well,
equity,
that's a good question. A
Yeah.
gift or an issuance to employees would require a valuation. Well, that's a very, very good point.
Yeah.
And Mike Lopez has his ears twitching here because he's had many clients I know that have dealt with this situation, this very situation. I want to give my employees equity. There's a 57 million hurdle. I'm going to give them equity, but they're not going to participate unless the company grows from the current level above 57 million. Is there a tax consequence? Is there any value to that equity? Well, there are those who would say, well, you know, you have 57 million, the company's worth about 57 million, the net is 0, it's not worth anything, you don't have to pay gift tax. But I think IRS would probably take the view that, hey, you know, I'll take those out. If you want to give them to me, I'll take them. They're worth a little something. They're worth a little something, and it would need to be
A nominal amount, I believe.
So, so it's worth something, and what it is something like a call option. So Bonnie's question to me at this point is, what's an option?
Okay.
Just to sort of back up for a minute and see where we stand. What do you mean when you say that's like an option? So an option is a derivative financial instrument, right? There are publicly traded options, and there are a lot of privately contracted options. An option is a call option, specifically, is a right, but not an obligation. A right, but not an obligation to buy a specified underlying asset at a certain price within a certain time period. The right, but not the obligation. So you can buy it. If it goes up, you make a lot of money because you've got the right to buy it at 3, and it goes up to 10, you buy it at 3, sell it at 10, you make a lot of money. So there's an upside, but you don't have the obligation, so there's no downside. Same situation that you're in, right? So the financial analysis regarding options pricing, call options pricing, is relevant to the valuation analysis in these firms where you've got this complex capital structure that has this combination of debt and equity in the equity section. Because the common can be viewed as an option. So let me just give you a simplified example. We had this really complicated equity section just a minute ago. Let me give you a simplified example. Let's say you got 100 shares of common. This is just like the example we were just talking about. You got let's simplify. You only got one class of equity. It's common, and the founder, you own it. You know, the entrepreneur founder owns all the shares, and has been running this digital media company and has done very well with it. And there's some senior managers that are essential to the company's future growth, and the founder entrepreneur wants to incent them by giving a piece of the action, and excogitates a plan whereby they can share in any growth beyond the current level. He got it up, she got it up to that level, but she wants them to be able to participate in that. So she writes this thing and says she gives out 25 shares to the 5 managers, 5 shares each of phantom stock, key employees, and says that, okay, I think my company's worth 10 million right now. At any sale price the phantom shares give them the right, a little bit like an MIP, give them the right and only the right to participate in any distributions from sale over the 10 million bucks. I get the first 10 million bucks. They get to participate over the 10 million on the sale. So there's a hurdle, okay, which is 10 million. So, and let's assume that your good valuation consultant comes in and says, well, yeah, you are about worth $10 million. The reason you want to set it at 10 million is that's what you think the company is. Okay, what I'm going to suggest is, or what I'm going to show you here is the way valuation people are valuing this kind of equity in a complex equity structure. This is the basic argument. This is a Black-Scholes-Merton calculation. It's the Excel spreadsheet that sets it out. That's the Nobel Prize that came for figuring out how to price call options back in the 70s. And this is the way it's set up in the present circumstance, where we're talking about an option not on shares, but on the whole enterprise value of the company. Because the hurdle, what's the hurdle? The hurdle is an amount that's going to come out of the whole enterprise value, right? It's that total of liquidation preference, or in this case, the 10 million. So the exercise price of the option is the 10 million hurdle. You don't get anything until you get above that. The underlying stock price, or is the value of the whole company, that you think the value of the whole company at that time, $10 million, right? We're going to put in a term for years, and we're going to put in the other inputs to the Black-Scholes. We may want to come back to those. And we're going to come up with a value. The call option value, according to the Black-Scholes-Merton formula, given those inputs, is $4.265 million. Now, what is that? That $4.265 million represents the value of being able to participate in the company value over the $10 million hurdle in the future.
Driven by the volatility.
It's driven by the inputs, and we're going to want to come back with that and beat that up, because that's really important.
Figure out what my volatility is as a private
company. It's not a perfect model, but I want to explain first the way the model works. So the model works is that you've got a call option on enterprise value. So the call option says that the right to participate for everybody who is going to participate over and above the $10 million hurdle is worth $4 million bucks. You got an option to do it, and let's assume it's okay for now. The phantom shares are 25. The common shares are 100. The founder shares are still 100, and the founder's going to keep participating, right? So the phantom shares will only represent 20% of a 20% participation in that amount over the hurdle. So you allocate to the phantom shares as a class, all of them, 20% of that number, or 853,000. And since there are 25 of them, you can divide that up and it comes to 35,000 or something like that. I worked it out and put it on the next slide. There we go. So that's the math that you do. And you say then that the phantom shares are worth, given these inputs and given this option pricing model, 853,000 or 34,000 each. That implies, since the whole company is worth $10 million, it implies that the common shares, the 100 common shares, are the residual. The 9,140,000 and 146,000. Now Lou's going to jump all over me. So that's the way you can do it, and that's the way it is done, and that's an option pricing model, an OPM, for common shares in a complex capital structure like this. And if your 409A is done properly, it's going to come up with an enterprise value of $10 million, and it's going to run some kind of an option pricing model allocation analysis to get to the part that's the common is worth. Because the common is not worth zero. The common's only worth zero on a liquidation waterfall, and we're not liquidating. We've got a going concern. So the going concern valuation is different and has different results in a complex capital structure than a liquidation analysis.
But for the sake of what are you doing this? After you do this calculation, where does that number go?
Well, there are a couple of ways in which it's useful. If those employees that those phantom stock units were given to are going to have to do something with IRS to show how much the value of this was. They're going to want to do an 83B election.
Not exercised, do they?
Phantom shares like this would normally be taxable income. You're giving it to your employees.
So these are phantom shares. I thought these, you have an option up there. Is an option different than a phantom share?
Even on an option, you have to prove to the IRS that you priced it at the money.
At the market value when
Yeah.
you get it out.
Yeah.
Right.
Right.
So you need the valuation even in that context.
It looks a little different, I think.
But an
Okay.
option's not worth anything unless you exercise it.
But you're going to pay that amount. And the way this would be set, if this was an option plan, is that you'd say, okay, the fair market value we've decided of a share is, some percentage of the 853,000 that we've gotten, and that's your exercise price. So you're not paying taxes on it because you haven't gotten that exercise price for free. You actually have to pay that exercise price to get.
So if the stock price is $10 and they give you an option at $9, the IRS wants their tax on that dollar of income that I've given you, even though you haven't exercised because it's in the money. If I give it to you at $10, the IRS says I've given you nothing yet. When you exercise and
So
sell.
that's why the legal terminology is it's a right to purchase, not an obligation, would lead you to believe there's not a taxable event.
Assuming that it's at the same value as the
Right,
stock.
okay.
And it
Which
depends.
You get a valuation from a guy like David, so when the IRS comes in and they question you, wait, David told me it was at the money. I have a piece of paper. And then they go away.
Right, right.
Yeah, okay.
Generally.
Okay, but there's more to my answer about that too, because it's clearly valuable in the sense that you got to deal with the IRS. You always have to deal with the IRS, right? So it's valuable there. But once you've got a model for valuing these securities in a complex equity structure, there's a lot of good stuff that you can do with it. For example, what if I told you that in an arm's length transaction, the 5 employees had acquired those phantom rights for $853,000? I could run my calculation backwards and I could back solve and I could tell you, based on that transaction, I would say your company's worth $10 million. So it becomes a tool. Well, now, Lou, beat up on it. It's not a perfect tool. What are some of the issues?
Volatility, which is that's the key driver. So if you set this volatility at 10% or 100%, you're going to come up with a greater value. So there's a lot of judgment. And you're the valuation guy, where do you get the volatility from?
Yeah,
I'm a startup company, I've been in business for 6 months.
That's a good question.
Haven't raised any preferred. Where's the valuation coming from?
So in general terms, the inputs to the Black-Scholes-Merton formula, to the option pricing, are the things that determine the level of value. So the question then becomes, well, how accurate are those?
And it makes more sense if you're a publicly traded company than if you're a private. Yeah.
Yeah. Okay. And I mean, well, it's 10 to 8, so I'm not going to give my lecture on the inputs to the Black-Scholes-Merton formula. I'd be happy to do that if anybody's interested afterwards. But there's the issue about there's the issue of the degree of accuracy of the model, and I think too there's the issue of whether the residual is the correct valuation for the common shares. It seems like a pretty indirect way to value most of to value the majority class. So you might want to run another valuation methodology on those to check it. I said that this is what's actually done. It is, and it is done for multiple classes of equity all at once, not just in this simplified example, and there's some literature on it. And I would just point out then that you now have a sense of the economics of the payoff of the different pieces of the class of the structure. And if you go back to the way the litigation was framed up, you'll see how clever or how appropriate it was. the plaintiff had the common shares, had an option. The option only has value if it has time. If you sell the company, there's no more option, right? It's an option to participate in future growth. I had a 3-year estimate in that option calculation that I did. If that 3 years goes to zero, Black-Scholes-Burton says that the option's worth zero if it's not in the money, right? What you've got is an in-the-money option. So what the plaintiff said that the board did wrong was that it sold. They sold too soon. They didn't give me a chance to recognize the value of my option, which required future growth. I know it's not worth anything now, but if you just let me grow, I've got some value.
Only if it grows more than 8%.
Because in the Trados case, exactly, it was a rising hurdle. And that brings us down to a rising exercise price in option terms, which brings us down to the judge's point of view. What the judge finally decided, what the chancellor finally decided, was that, you know, the odds of this company growing fast enough to give that option to give that common any value was low, based on the valuation reports. Not that the valuation reports were right or wrong. It's just they convinced him that the growth outlook for this company, risk adjusted, was not enough.
Well, the growth outlook was different. It wouldn't be $60 million because somebody would presumably pay more also. So the market kind of
Says the same thing. Yeah, that's a good point. Is in that valuation of the people that did the buying, assuming that it was shopped around and that you know that reflects the market. Yep. And one would normally make that assumption. Yeah, exactly. So you see the nature of the litigation and the basis for the decision depended upon this notion of the hurdle and common participating over the hurdle. So we're almost done, and we're coming back to Bonnie for the legal aspects of the decision. This was in Delaware Chancery Court, so what she's saying is strictly speaking relevant to Delaware law, but since Delaware is the benchmark court for U.S. business decisions, that's fairly generalizable.
Yeah.
What happened?
This is this is an illustration of a typical rule is the business judgment rule, which says that a court would give deference to the business judgment of the board of directors if it acts with due care and is not conflicted. In this particular case, the court found that there were multiple conflicts, and so it didn't follow the business judgment rule. It went to something called heightened scrutiny and entire fairness. So it determined what the price of the common should be.
Bonnie, let me make sure I understand that. You're saying that the court looked at the question of whether the board did things fairly, and they decided they didn't.
Right, exactly. So, it's a very odd decision to read, because you read the court criticizing everything that the board did. They didn't have a special committee to, composed of directors or others who were not conflicted. They didn't look to, an outside expert, a valuation expert. They didn't really go through a process to shop around the company much above the $60 million that they thought it was worth.
Bonnie, would this been thrown out if they had a fairness opinion? Would there have been a case at all?
There would have been a case, but it would have been a test around the fairness opinion rather than, the case. It would have been a much shorter case. Heightened scrutiny would sort of apply, and they'd look at, was there a fair process? probably fairness opinion, probably fair. On the other hand, if somebody had hired someone to get a fairness opinion, my guess is that they would have come out with a tiny amount being allocated to the comment. That's my cynical, non-numbers lawyer point of view. But
It's funny, I looked at it from just a general business person, I'm an accountant, and I said, all the preferred holders had a return. It's not as if any of them walked away with 0 return. They all had a return. So given that, and given the fact that there was so much conflict, like you, I felt similar that, common shareholders probably didn't have a lot of value, but they should have gotten something for their common shares.
all right. So I guess the thing that is interesting about the case from a legal standpoint is that if the valuation had come in differently and had not shown 0 as the value of the common stock, the defendants in the case could well have ended up making a payment to the common stockholders. So this really turned around on the value of the common stock and the way the court viewed that, rather than the conduct of the company, which is usually the determining value.
Let me ask that a question with that out there then. Ask a question of you as an attorney. So I find myself in this situation that I've been screwed. I was the founder, I built the company, I did all the right things. It got up to 60 million, we sold for 60 million, and I didn't get anything. I've heard that there's a Trados case out there, and that the Delaware court didn't give anything to the common shareholders in a case like this. Is there any point in my suing, or has Trados closed the book on my kind of complaint?
I think I could, if I can come up with a good valuation that is convincing to the court, I've got a decent chance. Because actually what this case says is that we won't just say we'll do whatever the board determines. We'll look at the board's process. The board's process, if it's unfair, we'll sort of substitute our own process. And so then it really depends on what the valuation comes out at.
So if you could get a valuation expert to come in and say that the company had significant growth opportunities, and although there was some risk associated with them, on a risk-adjusted basis, the company was conceivably worth more than 60 million.
Right. In that case, I think you'd have a decent chance to make that case to the court.
Okay, so it doesn't foreclose my suing
that.
if I find myself. It depends on the facts and circumstances.
Right. Exactly.
And so simply what you're saying is that the board, the preferred shareholders reached their fiduciary responsibility to the common shareholders by selling cheap, right? That's the moral of the story, right?
Well, it's a sort of funny kind of result, because they breached their duty, but on the other hand, they didn't have much of a duty because the common stock was 0, so was in value. That's the sort of the view of the court. So since I didn't, as a common stockholder, I didn't get less than what my value was. I wasn't damaged by this breach.
But isn't that because of a circular logic? Had the plaintiff not made the complaint they made, it wouldn't have been based on the valuation. If they hadn't said, if this were a going entity, it would have been worth more, that put them at risk for the valuation to be the answer.
Well,
had they said they fraudulently sold the company, then they could have played with the first 2 points.
No, I think that I don't agree with that. I think that the valuation came up because of the way the legal analysis flows. Normally, people come in and say, the company breached their fiduciary duty, and because of that breach, I was damaged. This is just like I'm driving down the street and somebody makes a wrong way turn into a one-way street and hits me. They breached their duty, I was damaged. But if I wasn't damaged, I don't really have a right to sue, even though they breached their duty. So that's in effect the simple way of.
How did the court conclude on valuation? Presumably they had some specialists then to come up with a similar opinion.
There were two, and they preferred one of the two, and it was the defendant's specialist who convinced the court that the company, that was a great sales price for the company, and that given the company's business plan and the outlook for the economy, it wasn't likely that they were going to grow faster than 8% going forward.
Just a comment. You made the point when you sort of that we moved on, but if the directors have not all been disinterested,
Right.
and they have been able to rely on business judgment rule, we wouldn't have even gotten into this entire
Right,
process.
exactly.
So to me, a cautionary tale for boards of small companies is that it's hard to get outside directors, but if everyone's own stock or is a preferred stockholder or management, you're conflicted. Just
Exactly.
by definition.
Exactly.
And
That's a very good point.
outside directors who are willing to take on that responsibility and make the judgment, you don't even get to the second one.
Exactly.
So if they concluded that the judgment was sound, it would have been open and shut.
Right, exactly.
Tested the valuation.
Exactly.
Good point.
Question?
Is there a site or book you would recommend taking a look at if you want to get an understanding of how the certificate of corporations are often written and how the equity is divided among the founders of the companies?
Bonnie?
I'm not thinking. There are a couple of books that are written on venture capital financing, and I'm blanking on the author's
There's
name.
a great website. It's the venture capital. Well, look at it.
Yeah.
It has all the forms on there, and they've got articles of incorporation
Yeah.
that are annotated.
Yeah, it's the National Venture Capital Association, NVCA.
Great.
You can find a set of sample certificate of incorporation and all the sort of investor rights types agreements.
Footnote, which is great.
Yeah, yeah.
Don't use them yourself. They're really not.
Yeah.
Well, just one comment here and then the next question. The case itself, the decision, is available to the public from the website of the Delaware Chancery Court. And the judge discusses some of the theoretical literature, including books on venture capital financing and the incentives of the venture capitalists as opposed to the companies in the literature. So a free download would just be the decision itself.
Yeah.
It's really brilliantly written. This is a fine judge. Question.
I have two questions. I'm a student, so forgive me if this question is not well versed enough. But my first question is, what role did par value play in the case? And then the second question is, could you please go back to the bibliography so that I can write down?
Oh, sure, of course. I'll do that while Lou answers the question about par value.
Par value is really an arbitrary value set for, frankly, I don't even know why.
Yeah, it's actually, the par value ends up being in people's certificate of incorporation, and the only use that I can see to it is that it sometimes governs how much franchise tax they need to pay. But it's really a meaningless an arbitrary number. In the old days, a preferred stock that you bought for $100 would have a par value of $100, but that was long before I was born. And yeah, yeah,
It's just
yeah,
practice and seen as
yeah,
that.
yeah, exactly.
I mean, typically, preferred doesn't even have a par. The common will have a par. But no relation.
In practice, because in theory, we're studying that it's very important.
That's right. It's amazing what you learned.
Thank you very much, I appreciate
Sure.
it.
If there aren't any other questions, I want to thank my panelists heartily for their great work on this project.